Today, we will talk about asset classes. An asset class is a grouping of investments that exhibit similar characteristics and are subject to the same laws and regulations. An asset class is a grouping of investments that exhibit similar characteristics and are subject to the same laws and regulations. Asset classes are thus made up of instruments that often behave similarly to one another in the marketplace. Examples of common asset classes include equities, fixed income, commodities, and real estate. Simply put, an asset class is a grouping of comparable financial securities. For example, IBM, Microsoft, and Apple are a grouping of stocks. Asset classes and asset class categories are often mixed together. There is usually very little correlation and sometimes a negative correlation among different asset classes. This characteristic is important in the field of investing. Historically, the three main asset classes have been equities, fixed income, bonds, and cash equivalent or money market instruments. Currently, most investment professionals include real estate, commodities, futures, other financial derivatives, and even cryptocurrencies in the asset class mix. Cash and cash equivalents represent actual cash on hand and securities that are similar to cash. This type of investment is considered very low risk since there is little to no chance of losing your money. Examples of cash and cash equivalents include cash parked in a savings account as well as U.S. government treasury bills, guaranteed investment certificates, GICs, and money market funds. Generally, the greater the risk of losing money, the greater the prospective return. Fixed income is an investment that pays a fixed income. Basically, you lend money to an entity and, in return, they pay you a fixed amount until the maturity date, which is the date when the money you initially invested is paid back to you. Government and corporate bonds are the most common types of fixed income products. The government or company will pay you interest for the life of the loan, with rates varying depending on inflation and the perceived risk that they won't make good on the loan. When people talk about equities, they are usually speaking about owning shares in a company. For companies to expand and meet their objectives, they often resort to selling slices of ownership in exchange for cash to the general public. Buying these shares represents a great way to profit from the success of a company. There are two ways to make money from investing in companies. The market can be volatile, though. Share prices are known to fluctuate, and some companies may even go bust. Commodities are basic goods that can be transformed into other goods and services. Examples include metals, energy resources, and agricultural goods. Commodities are crucial to the economy and, in some cases, are viewed as a good hedge against inflation. Their return is based on supply and demand dynamics rather than profitability. Many investors invest indirectly in commodities by buying shares in companies that produce them. However, there is also a huge market for investing directly, whether that is actually buying a physical commodity with the view of eventually selling it for a profit or investing in futures. Equities, bonds, fixed income securities, cash or marketable securities, and commodities are the most liquid asset classes and, therefore, the most quoted asset classes. There are also alternative asset classes, such as real estate, and valuable inventory, such as artwork, stamps, and other tradable collectibles. Some analysts also refer to an investment in hedge funds, venture capital, crowdsourcing, or cryptocurrencies as examples of alternative investments. That said, an asset's illiquidity does not speak to its return potential, it only means that it may take more time to find a buyer to convert the asset to cash. Investors looking for alpha employ investment strategies focused on achieving alpha returns. Investment strategies can be tied to growth, value, income, or a variety of other factors that help to identify and categorize investment options according to a specific set of criteria. Some analysts link criteria to performance and/or valuation metrics such as earnings per share growth or the price-to-earnings (PE) ratio. Other analysts are less concerned with performance and more concerned with the asset type or class. Here are 4 key takeaways. 1. An asset class is a grouping of investments that exhibit similar characteristics and are subject to the same laws and regulations. 2. Equities, e.g., stocks, fixed income, e.g., bonds, cash and cash equivalents, real estate, commodities, and currencies are common examples of asset classes. 3. There is usually very little correlation and sometimes a negative correlation among different asset classes. 4. Financial advisors focus on asset class as a way to help investors diversify their portfolios. Hope this would help. Thanks for watching.